Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
We're going to talk about an article from the New York Times.
Great.
The hottest thing in real estate is a loan from 2 years ago.
I like that.
Okay. This is obviously, Juana, why would you care what loan somebody has?
Well, you care what loan somebody has from two perspectives. One, if someone has a low interest rate, then they're unlikely to be a seller. And two, if they have a low interest rate and they happen to be a seller, then you would care to know that they have a low interest rate and that their loan is assumable. Now, I know that most of you out there think there's no such thing as an assumable loan. Yes, there is.
We're going to talk about it.
And lots of them are.
Okay. Real estate agents are pushing sub 3% mortgages as an amenity, just like marble countertops or a view of the mountains. We got a couple things we're going to talk about in here, and then we'll talk about the downside of this, because this was actually a huge thing in this probably 60s, 70s, and 80s, especially in the 80s when interest rates went up. If you went in the newspaper, which is how you found a house, there would be an ad, and it would say, "House for sale, I want $10,000 and you assume my loan." And you would give them $10,000 cash, and they would tell you the interest rate. I have an 8% interest rate. And you'd be like, oh, well, going rate's 14, so your 8% interest rate's going to be like much better.
Right. So for those of you who don't know what a newspaper is, because you've never seen one, you've never held one, you've never had that ink all over your fingers. A newspaper is a piece of paper that is really thin and has newsprint that rubs off on your fingers. Does that make sense?
It's Craigslist. It's Craigslist, but they print it.
Yes.
And then they distribute it through a distribution network of basically like 12-year-old boys on bikes.
Very gender specific. Okay.
It was boys.
Yes,
girls I never saw any girls delivering papers.
So if you want to give us a hard time in the comments, go for it.
Yeah, just wreck us in the comments. We're totally fine with it. That's how it was, so I can't. I'm not going to go back and change history because it doesn't fit somebody's narrative. Okay.
But here's the thing about all of these assumable loans, right? So getting back to serious business. So these assumable loans, they are assumable if it's an FHA or a conventional or a jumbo. It's probably assumable. You can find that in your deed, okay? So if you don't know where to find it in your deed, call your favorite title company and they'll be able to help you find it in your deed. And it says that it's assumable. Now, you can also call your loan servicer and you can ask them if your loan is assumable. You can ask them for an assumption package and they'll be happy to send that out to you. There are some things to remember with these assumable loans. Your servicer or lender has 30 days to respond to somebody applying to assume the loan. However, this is a big however, if you had loaned out money at 1 3/4, 2, 2.5%, 3%, how motivated would you be to let somebody assume that loan versus forcing them to get a new loan at the going rate of 6.5%, 6 3/4, 7%? Not that motivated.
Yep.
So keep that in mind. Even though these loans are assumable, and even though the lender has 30 days by law to respond to them, to the assumption request, keep in mind that they are qualifying and these lenders are not particularly motivated. So if you are one of these sellers that is using this as a selling point, keep that in mind, okay? So understand that buyer is going to have a hard time with your lender getting qualified to assume this loan.
Okay, here's the bad news. Most U.S. mortgages are not directly assumable. The ones that are assumable tend to be FHA and VA. All Department of Agriculture loans, but it's a very small number of loans. This is data from Chief Economist at Mortgage Bankers Association. They're also typically used by first-time buyers. VA, of course, you have to be a veteran to use that. This information came from
Okay, hang on. On the VA, there are two types. One, if you're a veteran, you can assume it, and then it goes against your VA eligibility. If you are not a veteran, you can still assume it, but then the eligibility for the original VA purchaser who is a veteran, then that still gets pegged against their eligibility, so then they can't borrow money again. So this is an important distinction.
Okay. This is the next slide then. So just wanted to just let the cat out of the bag. In theory, any of the millions of homeowners holding an assumable low-rate mortgage have a valuable perk to sell their home. Still, real estate agents say it can be hard in practice to transfer them. For instance, homeowners who transfer a VA-backed mortgage can lose their ability to get another similar loan unless they can find a VA-eligible buyer to take their original mortgage. This is absolutely true. Here's the other problem. Okay, so only about a quarter of all loans are assumable, right? The other problem is that's loans. So remember, 42% of all homes are free and clear. There's a 42% chance if you go buy a house, they don't have a loan. They own it free and clear, right? So that's it. So take that 42%, get rid of them. Now take the remaining 62% and take
58%.
I'm saying 58%. Take a quarter of that. Okay. So now you've got like, what's that? 14. Okay. 14% of all houses have an assumable loan. But remember, that doesn't mean that the loan is near the purchase price. So let's say they bought the house for $200,000. They got a VA, and they got 100% loan, $200,000. They maxed it out, and the house today is worth $400,000. They bought the house 6 years ago. It's doubled the price. The problem is you can assume their loan for $200,000, but you either have to now get another loan to make up the difference, or you have to put down cash. So to buy the house, you'd have to give them $200,000 cash and then assume the loan. Now you're probably saying, wait, how do they get their money if you're assuming the loan? Well, remember, they don't get the whole $400,000. Their loan gets paid off and they get the difference. So they would still make the same amount of money. The $200,000 would go in escrow. Commissions and fees would come off of it, and their $160,000 or whatever net proceeds they would still get.
Right. The other option, of course, is you assume their loan, you give them cash for some of the difference, and then the seller carries back some of the loan. So there are all kinds of ways that you can manipulate this.
Yeah, most people, I can tell you right now, that's the sliver 1%, because most title companies won't insure seller carrybacks. They're very difficult to find a title company that'll insure it, and because we've tried to do them in the past. And honestly, most people are like, I want my money. I don't want to carry a note. So what you want is, perfect scenario is, they bought the house a year and a half ago. They got a 3% rate. Rates were cheap, but for some reason they have regret. Like they need to move, or something's that changed in their life, and they don't have a ton of equity. They have like, I have $50,000 of equity. And you're like, fine, we'll give you $50,000 and we'll take over the loan, and then we'll take over your rate. But this can work, but it's, the reason we're telling you guys this is because I know there are people out there going, okay, this is how I'm going to take down my house. The other thing too is this. This is like the Burr method for house hacking. You buy, a fourplex, and you buy it, but you buy it and then you rent. Buy, rent. So you're living in one unit and you're renting out the other three. The problem is there's other people trying to do the same thing. So all of a sudden, the house has a 3% loan. If they're like, hey, so someone else is going to go, oh, well, I'll give you $55,000 if I can have your loan. And someone's like, their loan payment's 3%. I'll give you $60,000 if I can assume. So now it gets competitive. If people know what they're doing, if the agents and everybody knows what they're doing, this could be, there's not a lot of, unknown information in this.
Right. So a couple of things to remember. Most loans that are assumable are qualifying assumable, which means that the person assuming the loan has to qualify.
Yeah, meet the lender's qualifications.
So that's an important thing to remember. There are assumption fees that they're not great. There are a few $100 that they're not exciting, but there are assumption fees. There are some conventionals out there that are assumable. There are some jumbos out there that are assumable. So that's why I say take a look at your deed, because that's where you're going to have it written whether or not your loan is assumable. Talk to your servicer; they'll be able to help you with that. As far as what Todd said, we are in an environment where it is a seller's market. So buyers are going to have to get creative, and it's not that sellers can't sell their properties. So it's not that sellers have to induce buyers with their wonderful interest rates to buy their homes.
That's actually probably the biggest problem.
Right.
Most sellers are like, just put it on the market and sell it.
Right.
I don't want to deal with an assumption. Especially VA, because people don't want to lose their VA benefits. They want to keep using them, and unless it's a veteran. And how many veterans are there? 15 million out of 300 million people. Less than 5% of the population are veterans. So there's a very small chance it'll be someone who has VA eligibility that can even buy the thing.
Right. Some people don't care because maybe both partners are veterans. So it's like, well, I don't care if I don't have my VA eligibility because my partner does, whether it's a husband or a wife, and we can go buy another house under.
I can't imagine what percentage that is.
Right, it's a small percentage, but the point is that they are out there.
Yeah.
The number one thing to remember is we've got low inventory. Sellers do not have to use their loans as an inducement to get their property sold. But if you do come across a property that you like, and they do happen to have a smoking deal on their loan, you might want to inquire about assuming that loan.
Yeah, that's how I want to buy my next house. I want to get a sub 3% loan and just give them a bunch of cash and take it over.
There you go. Perfect. So, was this useful, interesting? Did you get something out of it? Then fantastic. Please make sure you leave us a note and tell us what you liked about the video and what we can do better. Please remember to like the video, subscribe, hit that notification bell so you get the next awesome video that we make. Share the video, and we will see you on the next video. Bye.
Bye.